Now, before we get into Asia, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at some of the things that we want to talk about before we get into some of these bigger shifts, especially when we talk about that common prosperity, we just want to look at the China manufacturing PMI, which, when you look at the advanced versus ISM manufacturing in the U.S., you get an idea of some of these pressure points that continue to kind of pull down on U.S. activity, because not only, as we've been saying for the last few months and showing different charts, obviously the U.S. pulls a lot and imports a lot from China. So as they slow down, there's just going to be less goods coming into the U.S., but you're also seeing, and as we've been talking about, the Chinese economy has been slowing. There's been a lot of headwinds coming out. And when you look at what is this cry in terms of dual circulation strategy, and I know I've had questions to really dig into that dual circulation strategy. I'll pull down some of the older charts and then update them, but in general, all that's really talking about is creating a local consumer. So the idea was create this dual circulation where, yes, you'll have the export market, but you also have a big growing consumer locally. And we're just not seeing that. And that's been that lag that we've seen in not just China, but also Asia. Because if you think about Asian culture, it's more along the lines of saving. They're very big savers. They're not huge spenders. And the idea was to try to turn that around and increase the consumption capacity of the locals to offset some of the losses that China has continued to see within the U.S., within Europe, as you've had trade wars, as we've had, increasing rhetoric, as you've had tariffs, all these different pressures on trade. The only way to easily replace that is to have locals. Locals can buy more, and that was the point of, and the underlying thesis behind that dual circulation, increasing local consumption, not only company to company, but company to consumer, and try to drum up some of that activity. So now when we look at the party's top economic policy body, the CCFEA, which Xi Jinping declared that promoting common prosperity is now at the heart of his economic agenda. So when you look at common prosperity, that's trying to bring up the lower class and trying to bring down, and again, not bring down but see some of this transfer of wealth from one to the other. So in the wake of the meeting, party state institutions have been scrambling to show that they are on board with Xi's agenda. And the PBOC they were the ones that were agnostic. They didn't really say anything yay or nay as common prosperity has continued to make the news over and over again. On Friday, the central bank held a meeting of its party committee. At the meeting, the PBOC declared, "We must make promoting common prosperity the starting point and focus of all of our financial work." But what does that mean? Like, how are they going to do that? Is it going to be triple R cuts? Is it going to be easier lending to the local, to consumers? Because we'll talk about in a minute how that's really starting to get difficult. Like, they're starting to reach a peak of, especially compared to developed nations, of the amount of debt that would be available to locals as the local consumer has already been borrowing, has already been more active, but yet still missing that dual circulation target significantly as retail sales are sluggish, consumer buying is sluggish. So the readout from the PBOC's Friday meeting simply reiterated a bunch of policy priorities that will be very familiar: maintaining reasonably sufficient liquidity, keeping the macro leverage ratio stable, making sure finance serves the real economy, supporting small businesses. And now supporting small businesses is going to be the bigger focal point, especially when you consider the next triple R cut, which is going to be, I think, at a lower, the small to medium banks, which target that small business versus some of the mega caps. Protecting against financial risk, ensuring that the financial system aids in rural development. For now, the common prosperity push will have little to no impact on monetary policy, but that's going to be something to watch as it could be changing. Now, when we start looking at tin, because when we look at Shanghai, we look at London, and remember, Myanmar has a lot of tin production, or I should say mining, when you look at the ore itself. So as we see these disruptions and as you see this push for Again, tin goes into semiconductors. You see tin and a lot of different, manufactured goods as these prices, as these essentially the record low amount of stock is going to essentially support some of these prices. And this also goes into, EVs and green technology. So again, all of these things continue to increase underlying pricing of raw materials, where you can quote lumber all you want, but lumber is not the only one, and you have to look at all of these different prices, all of these different exchanges, and how that's going to impact some of these different economies. So then when we look at some of the economies in general, so when we look at Australia, not surprising that PMI came in much worse at 43.3, composite at 43.5, manufacturing still holding above in a growth prospect of 51.7, but obviously with lockdowns, that'll continue to be under pressure. Then when we look at Japan manufacturing, you saw a little bit of a slowdown at 52.4. Services, again, got much weaker to 43.5, bringing the composite down to 45.9. This is where we continue to talk about this slowdown in Asia, and manufacturing has been okay. And you've seen that as we talked about in imports and exports, and you're seeing some of this come through. But the local component, the local services, the local purchases continue to underwhelm. You're just not seeing this a revving economy, if you will. You just see something that's languishing and really contracting on the internals, on the economic data and the internal levels. So then when we turn to Hong Kong, the CPI composite, again, remaining elevated 3.7%. But look at South Korea. South Korea PPI at 7.1% from a prior 6.4. I can't stress enough how that is just going to be imported directly into the U.S. So again, we continue to see prices going up around the world. We talked about the UK, we talked about Germany. Now, again, South Korea putting up another big number. So then when you look at manufacturing output, when you look at PMI versus manufacturing, the PMI continues to drift, but manufacturing output is starting to roll over. And we're just now starting to see some of this adjust, looking at some of the underlying, Australian data. And then when you look at services, unsurprisingly, you're starting to see that come down. So realistically, manufacturing production is also going to start to roll over. It's just going to fare better than services as we come to the other side of this. But again, it's just going to be another overhang for Asian growth in general. So now coming back to what is happening with costs. So China's labor costs are high and rising more quickly. So when we look at China manufacturing versus Mexico and Vietnam, this obviously looking at 2020, you're seeing that their costs are going up, making it again more and more difficult to rationalize keeping manufacturing there. Where do you go? What's the next step? And that's where we continue to see some of this rejiggering of the supply chain, which then drives in, well, how are they going to support their economic growth? And, China wants to keep growing. So what do they need? They need the consumer. But that's when we start looking at some of these pressures and some of these areas, which is why that dual circulation strategy marries very pretty with this I shouldn't say new narrative, but common prosperity. So dual circulation, increase buying, but give people money to do it under common prosperity. So again, you're starting to see these merge together to try to drum up some of this activity. And it's not surprising given some of these pressure points. So Wang told reporters, there are too many one-off factors that are gradually disappearing when you're looking at foreign trade. So foreign trade value grew 24.5% year over year in the first 7 months of 2021, fastest growth rate in a decade. Wang attributes that growth in part to COVID-19 outbreaks disrupting manufacturing in other countries while China's factories remained open. It's also important to see it's trade value, not trade volume. Trade value is going up because PPIs are going up. When you look at the disconnect, as we have multiple charts over the last 4 months looking at China's CPI versus PPI, PPI has gone parabolic while CPI has stayed flat. Why? Because they're trying to export more of that and protect the local consumer. Again, trying to drum up the consumer, trying to drive that retail sales, so they're exporting it into others. The Commerce Minister gave a pretty frank assessment of the growth of foreign trade cannot be so high all the time. We hope that the growth of foreign trade will be within a reasonable range. And then Wang warned again that trade will face serious headwinds in the months to come, namely disruptions to shipping, including high rates and insufficient capacity, rising prices for commodities and raw materials, yuan appreciation, and rising labor costs. Labor costs are going up, which is going to have to get passed through. And you can see the trend from 2016 to 2020, and 2021 is no different. So Wang reassured reporters that MOFCOM is standing by to support traders should the need arise. Regulators have been aware for a while now that high commodity prices and yuan appreciation is masking weakness in trade data. Again, rising prices, again, volume versus value, as we keep talking about. They've been telegraphing plans for a variety of support measures since mid-July. So again, things to focus and to talk about and to look at as we go forward. But then we turn to China credit impulses. So when we look at the PBOC, they're still very, very focused at, as we've been talking about, keeping things stable at this region, still in a negative capacity, still drawing liquidity out, but again, not continuing to go down, but stabilizing at this level going sideways. So what is that looking to do? So when you look at, again, what they're trying to accomplish, and this is why when we talk about the PBOC, we have to see, okay, well, they don't want to add liquidity back in too quickly. They don't want to add it back in without countering it some way. And this is, again, managing some of these credit impulses. So the Standing Committee of the National People's Congress reviewed a budget execution report from the Ministry of Finance, which, when we look at what budget hawks wanted, from January to July, government revenue totaled 13.77 trillion renminbi, up 20% year over year. Across the same period, government expenditures totaled 13.79 trillion, up 3.3% year over year. So again, you're starting to see them trying to refill the coffers because there's some of these fears of what is the off-balance sheet debt, what does that look like, and we've seen Yurong, we've seen issues with Huawei, with trade war, with trade issues, and then obviously with Evergrande, which continues to be a problem. So according to the report, work for the second half will be improving policy effectiveness, controlling spending, improving fund management and monitoring, resolving local government debt risks, which is the big one, reforming the fiscal and fiscal and taxation systems as they continue to give some benefits to smaller companies as they try to drum up, again, more employment, more hiring, more local hiring, again, kind of back to that dual circulation, strengthening financial and accounting supervision. And they continue to try to tighten their belt given the spending, which is what we can see here when we look at credit impulses. So then they're also looking at reducing some of the government tasks, so administrative tasks and the number of inspections, while highlighting the problem of unnecessary and repetitive meetings, paperwork, and performance evaluations. The meeting asked localities to guard against and rectify newly emerged practices of formalities for formality's sake. That doesn't mean that lower level officials are allowed to do a poor job. The component or authorities will will divvy out severe punishments to those causing serious consequences due to their superficial measures on pandemic response. Now, this is new. The Central Committee General Office released a circular with similar action points in March 2019. So 2.5 years on, bureaucracy and inaction remain rampant. So again, they're still trying to do something but again, it's making more efficiency, decreasing cost, because they're trying to just streamline the process because they continue to see these costs going up. When you look at credit impulses, the PBOC is continuing to pull some of this liquidity out of the market. But when you look at the three tranches of the RRR, you have the 6 big banks, the 150 medium-sized banks, and then the 400 smaller banks. When they do the next RRR cut, if they really want to try to drive that common prosperity, drive some of that local consumption, you're going to see it at the lower 4,000 or so banks, as that's where you see the biggest lending from one to the other. And you'll see the big six staying elevated. As we said with the most recent RRR cut, it was really just to shore up balance sheets and make more cash available at the bank level, not that it was going to get redistributed in terms of loans, where the next one we think is going to be a bit more targeted to try to drum up and increase lending and cash available to the small and medium. But then when you look at the private sector debt levels, when you look at where things are in terms of outstanding debt, you have to look abroad. When you look at where things are going, the private sector debt levels will ensure a continued easing bias, because there's still a significant amount of debt sitting at the local level, at the household level, that they need to try to manage to avoid some of these rolling issues. And as we said in China, and we'll talk about it again in a minute, it's not just China. It's all of Asia is seeing something similar. When you look at Korea, Malaysia, Thailand, especially India, when you get to close to 100% of GDP, as you see rates going up, as you see inflation going up, there's going to be a fear of, well, what is this? What do these rates look like? Can you roll this debt? And what is that cost going to be? Which is why they have to maintain some easing policy versus, I think, what they would really like based on where inflation is and where some of those risks underlie. So then when you look at this, again, this slogan selling, as I thought Bloomberg did a nice job of saying it, of the common prosperity, it's not new. And that's the one thing that we want to talk about, where it's not a new thing. Like, this is something that came out very, at the middle to end of 2020. It's just now been carried forward because it really goes hand in hand with that dual circulation, where going after where the Deng mentioned, the comments were, let some get rich. Now it's, okay, you've gotten rich, now it's time to pay your piece. And you're starting to see that narrative creep when you look at what has Xi done. He's increased the training of, the amount of CCP training, the amount of communism training, respecting the party, Mao. All of these things are getting back to, for lack of a better term, communist roots. And that's where you're starting to see some of this pivot, which marries well into it. Now, when we look at the declining loan rates are further squeezing bank margins, this is what we continue to see within China, where weighted average loans continue to come under pressure, which when you look at commercial banks is starting to, again, compress, which is why we saw that RRR cut. We started to see, how can they shore up balance sheets? How can they make sure there's enough debt, there's enough cash available to backstop some of these loans that remain in the market? But when you look at what is hidden away, what are some of these issues that reside outside of just what is at the consumer? Well, you look to the Chinese local governments with the implicit debt, which again is more of that hidden debt, and a think tank put it at about 15 trillion yuan, which again is just an estimate. I mean, no one really knows what this number is, as we've seen with the great financial crisis in the US. So hidden debt refers to funds raised by government-related entities like local government financing vehicles, or the AGFVs that we talk about, to pay for infrastructure spending and other public projects, all of which essentially since 2016 are underwater, being managed and paid for by tax revenue. The debt raised is kept off the balance sheets of local authorities, yet carries an implicit government guarantee of repayment. A researcher, Estate Linked, put it at about 14.8 trillion yuan last year. The hidden debt problem is seen as so serious that the government this year called it a national security risk and ordered officials to deal with it by paying down debt or bring it onto the balance sheets of local authorities. So that's why you're starting to see these increases in debt. And even still, how do we know how honest they are? How, are they scared to show what their pressures are and what the overall risk is to that entity? So in response, some provinces, cities, and counties across the country have started publishing their repayment or refinancing plans because it's so much. They need to come up with a way to pay it off. Shanxi province authorities included tackling hidden debt as a criteria to evaluate officials' performance from this year, while Guangzhou province said it had resolved 33.7 billion yuan off balance sheet debt in the first 6 months of 2021. Shenzhen City, China's technology hub, pledged to clear all its hidden debt in 2021. Again, easier said than done, especially because the PBOC is trying to take liquidity out, tightening their belts, making some of this going to be very difficult to rehash, which is why when we start turning to What are the expenditures in China? What are they trying to do? So services lag more than goods and spending recovery. Remember, they dual circulation strategy, trying to get more purchases, trying to get more of this movement, and you're just not seeing it run through, where real expenditure services have slowed over that time period. When you look at the service side, so some expenditures, food, clothing, have gone up, especially on food when you look at the percent year over year. But when you look at retail sales have slowed, and real disposable income is down from 2019 when you look at the average growth into 2021, which again is something that they're trying to address to drum up that capacity. But caution spreads when you look at disposable income versus expenditures. So disposable income has come down, but expenditures have tightened more. Again, the opposite of what they want to see when you're looking at trying to drive the economy, trying to drum up the consumer, which is, again, seeing some of these pressure points that have continued to be worse. But when you see your disposable income reversing and getting worse, you're going to wait for that to go positive before you start to really increase your expenditures, because people get overly cautious and then they're slower to come back, and they wait for a month or two to make sure that it's not a fluke that you get this disposable income growth, because you're seeing, again, the 2-year average growth has been negative on the disposable income side, and then has been negative on the expenditure side, something that they want to address, which is why that dual circulation strategy, common prosperity, has become the narrative and the shift for 2020 into 2021. But then when you look at the virus hitting local incomes and consumption, you're just looking at how impactful it's been across multiple areas. This isn't just the poor areas. This is all across the country that you've seen this impact to overall incomes, and then obviously off that consumption. So then when you look at, well, you can't give them more debt because China's household debt as a percentage of GDP has approached developed country levels. So how much more debt can these individuals really take on if you've seen their disposable income come down and their consumption fall as well? So if income's coming down, how can you increase debt? Because that's going to be a bigger ask, and it's just going to take even more disposable income, where money that would have gone to disposable income into the debt market and servicing this debt, which again is becoming that underlying problem. And then when you look at home prices, which is why they want to make things more affordable, home prices are vastly more expensive in China as a multiple of incomes. Two measures serve to illustrate how extended prices have become in leading cities. Prices relative to average incomes are orders of magnitude greater than in global metropolises such as London, New York, or Sydney, where valuations are often viewed as unaffordable, according to Numbeo, a cost of living data collection website. As you can see, Shenzhen, Hong Kong, Beijing, Shanghai, all of them are massively expensive, even compared to where we sit in New York and some other areas, which is why, again, these pressure points, which is the common prosperity push, making housing affordable, going after private tutors, private schools, trying to make things more affordable and create that common prosperity through dual circulation, increasing disposable income. But how do you increase disposable income? That you need more jobs, you need better jobs, you need higher paying jobs. So you have to give companies more money. So how do you do that? You lower their cost of capitals by taking down the RRR. It all starts to come together when you piece it together and look at China measured in years and not months or quarters, because you have to look at what the trajectory is. Because even though it's opaque, it's difficult to understand China, they give enough information that you can piece it together if you're looking at the right spots, which is what we try to do. So if you have any questions, please let us know. We always love the back and forth. Again, you can find me at MarkFNY on Twitter, and then M Rossano at c6capitalholdings.com, or in the comment section, where we love to hear from you. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.